Historically, aging has been perceived as a biological inevitability, as a law of nature embedded in the very structure of living things. Medicine reacted to symptoms, pharma patched holes, insurance companies calculated the probability of death. The entire healthcare system was built around the idea that the wear and tear of the organism is a given, which one can only accept and mitigate its consequences. This paradigm held for centuries, not because it was correct, but because there was no technological alternative. Doctors treated heart attacks but could not prevent cardiovascular aging. Oncologists fought tumors but could not stop the accumulation of mutations in cells. Neurologists slowed the progression of dementia but could not reverse neurodegeneration. Each specialty dealt with the consequences of aging, but no one worked on the process itself. But economically, the model was catastrophic. Aging is the main driver of expenses for any developed healthcare system. In the USA, over 70% of medical expenditures are for treating chronic diseases related to age. Type 2 diabetes, atherosclerosis, osteoporosis, arthritis, Alzheimer's disease, all share a common root factor: time. Pensions turn into a burden for state budgets. Insurance companies operate on models where age is only an increasing risk. Demographics become a debt pit, and a person's productive lifetime value steadily declines after a peak at 40 to 50 years. The economic reality is simple and cruel. A person as an asset depreciates with each passing year. Their biological capital dwindles. Their cognitive abilities decline. Their physical strength diminishes. Their health requires more and more investment with diminishing returns. This is not about morality. It's a balance sheet. And this balance was accepted as an immutable given. Economists built pension system models based on the idea that average life expectancy grows linearly and predictably. Actuaries calculated insurance premiums based on mortality tables that changed insignificantly from decade to decade. Corporations planned human resources based on the premise that an employee works 30 to 40 years and then retires. But over the last 15 years, a shift has occurred. Not in public consciousness, not in medical practices. The shift happened in technological capability. Genomics ceased to be exotic and became an engineering discipline. The cost of full genome sequencing dropped from $3 billion in the early 2000s to several $100 today. That's a drop of 7 orders of magnitude in 20 years, a pace comparable to Moore's law in computing. And this opened the door to mass-personalized genomics. Epigenetics showed that DNA is not a rigid code, but a dynamic program that can be edited. DNA methylation, histone acetylation, chromatin modifications, all are mechanisms through which cells control gene expression without changing the DNA sequence itself. And it turned out that epigenetic patterns change with age in a predictable way. Steve Horvath developed epigenetic clocks, an algorithm that determines a person's biological age from methylation patterns with an accuracy of 3 to 5 years. This was a breakthrough, because for the first time, there was an objective biomarker of aging that could be measured, tracked, and, potentially, changed. Cellular regeneration turned from a theoretical concept into working protocols. Yamanaka factors, 4 transcriptional factors that can reprogram adult cells back into a pluripotent state, showed that cellular aging is reversible. Initially, this was used to create induced pluripotent stem cells for research. But then scientists discovered that partial reprogramming, brief expression of Yamanaka factors, could rejuvenate cells without them losing their specialization. Mice subjected to such reprogramming showed improved tissue function, restored regenerative capacity, and increased lifespan. Senolytics, drugs that selectively remove senescent cells, went from concept to clinical trials in 10 years. Senescent cells accumulate with age. They stop dividing, but do not die. Instead, They secrete inflammatory factors that damage surrounding tissues. This phenomenon is called SASP, senescence-associated secretory phenotype. And it turned out that if you remove these cells, many age-related pathologies regress. In mice, senolytics removed atherosclerotic plaques, restored kidney function, improved cognitive abilities. The first clinical trials in humans showed safety and preliminary efficacy. This is no longer fundamental science. This is applied medicine. Artificial intelligence learned to build models of aging that are more accurate than classical biomarkers. Deep learning algorithms, trained on millions of medical images, can determine biological age from a retinal scan. Other models predict age from blood analysis, gut microbiome, gene expression patterns. These AI models don't just classify. They find hidden patterns the human eye cannot see. They identify which biological processes correlate most strongly with age, and this information becomes a guide for interventions. And suddenly, aging went from a biological fact to an engineering problem, with all the ensuing consequences. Engineering problems are solved. Biological constants are not. And once aging moved from the second category to the first, it automatically became an object for investment. Not charitable, not humanitarian, commercial. Because if aging is the manageable technical debt of the organism, then it can be optimized. And everything that can be optimized can be monetized. The investment logic here is crystal clear. Life extension is an increase in a person's lifetime value. And not linear, but exponential. A person who lives 120 productive years is not just two 60-year-olds. It's a completely different class of asset. They accumulate knowledge, connections, capital, skills over decades. Their cognitive peak stretches. Their ability to generate value does not drop after 50. Their retirement horizon shifts back by decades, relieving the system. Their investments in education, health, and career pay off many times over. This is not humanism. It's pure arithmetic. Consider a concrete example. A top manager of a large corporation at 55 is at the peak of their competence. They know the industry. They have a network of contacts. They understand how to make decisions under uncertainty. Their annual salary is $2 million, but the real value they generate for the company is $20 to $30 million. In 10 years, they will retire. The company loses this asset. It will have to find a replacement who will learn for years, make mistakes, slowly accumulate experience. Now imagine the company invests $100,000 a year in a longevity program for this manager. Biomarker monitoring, personalized nutraceuticals, preventive gene therapy, senolytics. And thanks to this, their biological age does not increase. At 70, they are biologically 45. They continue to work for another 20 years. The company gets an additional 20 years from an asset worth $30 million per year. That's $600 million in added value for a $2 million investment. ROI 300 to 1. This is not fantasy. This is math that corporate CFOs are already calculating. Biology is becoming infrastructure. The human organism is not a car that inevitably goes to the scrap heap. It's an operating system that can be patched, updated, modified. Longevity is turning into an ultra-long-term bond, an asset that generates returns on a horizon inaccessible to classical financial instruments. Sovereign funds that invest on a 50 to 100-year horizon are beginning to understand this. The Norwegian Oil Fund, the world's largest sovereign wealth fund, is already exploring investment opportunities in longevity as a hedge against the demographic crisis. Singapore's GIC considers biotech a strategic sector on par with semiconductors and fintech. But herein lies the illusion of reliability. Regulators still think in terms of diseases, not age. The FDA, EMA, and other agencies operate within frameworks where aging is not a diagnosis. You cannot treat what formally is not a disease. You can treat diabetes, cardiovascular diseases, neurodegeneration, but you cannot treat age itself. This regulatory absurdity holds back the industry by decades. This regulatory wall is not just a bureaucratic inconvenience. It is a fundamental barrier for the entire industry. Imagine, you have developed a therapy that in clinical trials shows improvement in all key biomarkers of aging: reduction of systemic inflammation, improvement of mitochondrial function, restoration of the epigenetic profile to a younger state. Patients feel better, their physical endurance increases, cognitive tests show improvement, their biological age by epigenetic clocks decreases by 5 to 7 years. But the FDA says, this is not proof of efficacy. Show us that it actually prolongs life or prevents specific diseases. This requires studies lasting 20 to 30 years, randomized controlled trials on thousands of patients who need to be observed until their death to statistically prove an increase in lifespan. The cost of such a study is billions of dollars. The time horizon is a generation. No one will fund such trials. No venture fund will wait 30 years. No public company can withstand such uncertainty in its pipeline. And the therapy gets stuck in limbo between works in research and not approved for use. Some companies try to bypass this through indication hopping. They position their therapies not as anti-aging, but as treatment for specific age-related diseases. Metformin, an old diabetes drug, is being studied in the TAME trial, targeting aging with metformin, as a geroprotector. But formally, it is not being tested for life extension, but for delaying age-related diseases. Rapamycin, a powerful immunosuppressant, showed a 20 to 30% increase in lifespan in mice. But in humans, it is used only after organ transplants. Attempts to study it as an anti-aging agent run into concerns about long-term immunosuppression. Senolytics are being tested as therapy for idiopathic pulmonary fibrosis, osteoarthritis, chronic obstructive pulmonary disease, but not for aging per se. This works to get regulatory approval in a narrow niche, but it also limits the market. Because a drug can only be prescribed for approved indications, and mass use for life extension by healthy people remains in the off-label zone, creating legal and reputational risks. Doctors are afraid to prescribe. Insurance companies refuse to cover. Patients don't want to risk it without official approval. Ethics lag behind technology even more strongly. Society is not ready for an economy of 120-year-old people. For a world where access to life extension becomes a new form of class stratification, for questions about who will get the right to immortality and who will remain in the category of expendables, philosophers and bioethicists debate whether it is even moral to strive for radical life extension. Religious leaders warn about attempts to play God. Sociologists point to the risk of gerontocracy, the rule of eternal old people who will block social mobility for younger generations. But capital does not wait for consensus. It seeks opportunity. And the opportunity here is larger than anything since the Industrial Revolution. Because aging is not a niche problem. It is a universal problem. Every person ages. Every market depends on people's productivity. Every economy bears the costs of an aging population. It is a total addressable market, 8 billion people, and each of them is a potential customer of the longevity industry. Even if only the top 1% by income can afford advanced longevity therapies, that's 80 million people. If the average lifetime spending on longevity is $100,000, a conservative estimate, that's an $8 trillion market. And that's just the beginning. As technologies become cheaper and more accessible, the market expands to the next 10%, 20%, 50% of the population. This is not just a big market. It is the biggest market that has ever existed. Classical pharmaceuticals make money from diseases, from something that broke and requires repair. This is a reactive model, transactional, one-off. A patient gets sick, receives treatment, pharma gets income. A course of antibiotics costs $50. A monthly pack of statins, $100. These are relatively small amounts, distributed across millions of patients. Profit is built on scale and on developing blockbusters, drugs with multi-billion-dollar sales. But this is the model of the past. The new longevity economy is not built on transactions. It is built on subscription, on continuous relationship, on lifelong integration of technology into biology. Longevity startups position themselves not as drug manufacturers, but as platforms. Biohacking is turning into a subscription economy. Personalized medicine becomes SaaS, software as a service. Only here, the service is life itself. It's not a one-time purchase of a drug. It's a subscription to biomarker monitoring and optimization, to continuous analytics of the body's state, to real-time adjustments, to personalized protocols for nutrition, physical activity, nutraceutical intake, preventive pharmacology, gene therapy. The revenue models here are fundamentally different. The first level is subscription to biomarker monitoring. Companies like Inside Tracker, Viome, Thorne offer regular testing of a wide spectrum of biomarkers. This is not just a general blood test. It's deep profiling. Metabolic panels, inflammatory markers, hormonal profiles, vitamins and minerals, oxidative stress, mitochondrial function. Some platforms add genomic and microbiome sequencing. Data is collected every 3 to 6 months. Cost from $100 to $1,000 per test, depending on depth. But testing itself is only the entry ticket. The real value is in analytics and recommendations. Data is uploaded to an AI platform that compares it with reference databases, builds longitudinal tracks, identifies deviations from the optimal state, predicts risks. Machine learning algorithms trained on millions of biomarker profiles find patterns that precede the development of diseases. The user gets not just numbers, but actionable insights. What to change in diet, which supplements to take, which types of physical activity are optimal for their biological profile. This is personalization at a level unattainable in traditional medicine. And it's a monthly subscription. From $100 to several $1,000s, depending on the depth of analytics and level of personalization. The second level is lifetime health extension contracts. This is no longer a subscription to data and recommendations, but a subscription to outcome. A clinic or platform takes on the obligation to maintain a client in a certain biological state. A contract for 10, 20, 30 years. The client pays not for procedures, but for biological age. If your biological age at 50 corresponds to 40 by epigenetic clocks, the contract is fulfilled. If not, the platform loses money or provides additional interventions for free. This is a radical rethinking of the business model. Risks shift from the client to the provider. But the margins here are completely different. A lifetime longevity contract is not a one-time payment. It's an annuity, recurring revenue for decades ahead. The client pays, say, $50,000 a year. Over 20 years, that's $1 million from one client. And the longer the client lives, the longer they pay. The paradox is that the platform's success in extending the client's life increases the duration of the cash flow from that client. This creates perfect alignment of incentives. The platform is maximally interested in the client being healthy and living long. Unlike traditional medicine, where a hospital makes money from patients' illnesses, a longevity platform makes money from their health. Companies like Human Longevity Inc., founded by Craig Venter, offer exactly this model. Health Nucleus, their flagship product, is a comprehensive examination costing $25,000, including whole genome sequencing, full-body MRI, cardiac examination, cognitive testing, and consultations with a team of specialists. But that's just the beginning. Then comes long-term support, protocol adjustments, preventive interventions. The lifetime value of a client is measured in hundreds of thousands of dollars. The third level is the B2B segment, corporate longevity. Companies are beginning to understand that their main asset is not real estate or patents, it's human capital. And if this capital can be extended, increasing its productive lifespan by 20 to 30 years, then the ROI from such an investment is astronomical. Corporations sign contracts with longevity platforms not for all employees, but for key ones, for top management, for bearers of critical competencies, for those who generate disproportionate value. This is not a social package. It is an investment in extending an asset. Imagine a tech company that has a chief engineer who knows the entire product architecture. This person is irreplaceable. Their departure would create a hole in knowledge management. The company pays a longevity clinic $100,000 a year for comprehensive health optimization for this engineer. In return, the clinic guarantees monitoring of all critical biomarkers, preventive intervention for any deviations, access to experimental therapies. The goal is to extend this person's career by 10 to 15 years beyond the norm. If their salary is $2 million per year and the value they generate is $20 million, then a $1 million investment over 10 years pays off 200 times over. Some corporations go further. They embed longevity benefits into compensation packages for senior executives. Stock options, bonuses, and a comprehensive longevity program. This becomes a competitive advantage in the war for talent. The best specialists choose not only by salary, but also by which company invests in their long-term health. This is a new form of retention. Because if you receive therapies from the company costing $100,000 a year, leaving means losing access to those therapies. These are golden handcuffs of a new generation. Only instead of financial options, biological optimization. The fourth level is a new type of insurance. Classic life insurance is built on the insurance company betting against your life. It collects premiums and pays beneficiaries after your death. The earlier you die after taking out the policy, the worse for you and better for the insurer. The longer you live, the more premiums you pay. Actuarial tables are calculated on the average person living a certain number of years, and premiums are set so that the collected money plus investment income covers future payouts. The new model is health optimization insurance. Insurance covers not death, but deviation of biological age from the optimal track. You regularly undergo biomarker tests. If indicators worsen, inflammation levels rise, mitochondrial function declines, epigenetic age accelerates, the insurance pays for interventions to correct it. This could be a personalized nutrition plan, an exercise program, nutraceuticals, preventive drugs, even cellular therapy. The goal of the insurance company is not to wait for your death, but to delay it as much as possible. Because every year of your healthy life is a year you pay a premium but don't require large payouts. This is an inversion of traditional logic. The insurer becomes a partner in your longevity, and economically it makes sense. If an insurance company can lower the biological age of its clients by an average of 5 years, this dramatically shifts the mortality curve. People die later. But all that time they pay premiums. The net present value of cash flows for the insurance company increases. And simultaneously, age-related claim expenses decrease. Fewer heart attacks at 60, fewer strokes at 70, less dementia at 80. Some insurance companies are already experimenting with this model. They offer reduced premiums to clients who undergo regular biomarker monitoring and follow evidence-based longevity protocols. They partner with longevity clinics to provide services. They use wearable devices for real-time monitoring of activity, sleep, heart rate. and they adjust premiums dynamically based on biological data. If your biological age decreases, your premium drops. If it increases, your premium increases. This is usage-based insurance for the human body. The fifth level is selling data. This is the dark matter of the longevity economy. Genomic data, metabolomic profiles, epigenetic patterns, longitudinal health data. All this is incredibly valuable. Pharmaceutical companies pay millions for access to such datasets. AI companies need them to train aging models. Research institutes build new theories on them, and longevity platforms sit on a gold mine. Each client is not just a source of subscription revenue. They are a source of biological data that can be anonymized and monetized. This is dual revenue, and the second is often higher than the first. The value of this data grows non-linearly. One genomic sequence is worth several $100s on the market. 1,000 sequences linked to phenotypic data, already hundreds of thousands. 1,000,000 sequences with longitudinal health, lifestyle, response to intervention data, that's tens of millions. Because here emerges the ability to build predictive models, find patterns, determine which genetic variants are associated with longevity, which epigenetic changes predict diseases years before clinical manifestation, which metabolic profiles indicate accelerated aging. This is not just data, it is a map of biological reality. And whoever owns this map owns the navigation. Platforms already understand this. They are building not just services for clients, they are building data moats. The more data they collect, the harder it is for competitors to catch up. Because the quality of AI models depends on the volume and quality of training data. And collecting millions of longitudinal health records is a task that takes decades and billions of dollars in investment. Whoever started first got an insurmountable advantage. It's the same logic that worked for Google, Facebook, Amazon. Network effects of data. Only here the data is not about clicks and purchases. Here, the data is about life itself. 23andMe, a personal genomics company, has collected genetic data from over 15 million people. It is the largest private genetic database in the world. And the company monetizes it through partnerships with pharma and biotech. GSK paid 23andMe $300 million for a 4-year access to data for drug discovery. That's more than 23andMe earned from selling tests directly to consumers. Data became the main business. Scale effects work differently here than in classic tech. One biological stack can be applied to millions of organisms. After R&D is complete, each new client is almost pure margin. The cost of an additional test decreases with scale. The cost of data analysis is fixed. The AI model works the same whether it processes 100 or 100,000 profiles. Marginal costs tend towards zero. These are software-like economics in a biological industry. But the main thing is the network effect of aging data. The more people use the platform, the more data it collects. The more data, the more accurate the AI models. The more accurate the models, the better the personalized recommendations. The better the recommendations, the better the results for clients. The better the results, the more new clients are attracted. This is a closed growth loop, identical to what created monopolies in social media and e-commerce. Only here the stake is not engagement or purchases, but years of life. Investment players are already on the field. Biotech VCs, previously focused on pharma and medical devices, are massively reorienting to longevity. Andreessen Horowitz launched a dedicated biofund focused on anti-aging. Khosla Ventures invests in senolytics and cellular reprogramming. Peter Thiel's Founders Fund invested hundreds of millions in Unity Biotechnology, a leader in senolytic development. Big tech is also entering aggressively. Google, through its subsidiary Calico, invested over $1.5 billion in longevity research. Amazon launched Amazon Care and is expanding into healthcare, understanding that health and longevity is a recurring revenue model perfectly suited to their platform approach. Apple turned the Watch and Health app into the largest personal health platform, collecting biometric data from millions of users daily. Sovereign funds, especially from countries with high life expectancy and demographic challenges, are considering longevity as strategic infrastructure. Singapore's GIC, managing assets over $600 billion, has allocated longevity as a separate investment category. Japan's GPIF, the world's largest pension fund, is exploring investment opportunities in biotech as a hedge against Japan's aging population. Private wealth and family offices with long horizons are increasingly allocating longevity as a separate category of alternative assets. This is no longer just a diversification play, it's a strategic bet that the longevity market will become one of the largest in the next 30 years. And early positioning will give disproportionate returns. Even classic pharma, which long ignored the topic, is starting to enter as catch-up capital. Not because it believes in radical life extension, but because it's afraid of being left out. Tech history is full of examples where technology worked flawlessly, but the market collapsed. Where regulators banned what engineers had already built. Where society rejected what made economic sense. Longevity is no exception. It is perhaps the most vulnerable market precisely because it touches not just money or convenience. It touches the very essence of human existence. And here, the risks are unhedgeable. Let's start with technological ones. Problem number 1 is replicability of research. Most breakthroughs in longevity research are made on mouse models. Mice that live 30 to 40% longer thanks to dietary restrictions, genetic modifications, senolytics, rapamycin. This is impressive. In laboratory conditions, these results are reproducible. But mice are not humans. Their metabolism, their cellular mechanisms, their response to interventions are fundamentally different from humans. Mice live 2 to 3 years. They can be studied throughout their lifespan in controlled conditions. Genetic modifications impossible in humans can be tested. Inbred lines with identical genetics can be created for experimental purity. But extrapolation from mice to humans is notoriously unreliable. Most drugs that show an effect in mice do not work in humans. Or they work, but with side effects not seen in mice. Or they require dosages incompatible with human physiology. What works in mice works in humans at best 20% of the time. At worst, not at all. And between mouse studies and human results lie a decade of clinical trials and hundreds of millions of dollars. And most of that money burns to nothing. Phase 1 trials test safety. Phase 2, preliminary efficacy. Phase 3, full-scale efficacy on thousands of patients. The success rate of transitioning from each phase to the next is 30 to 40%. The probability of a drug going from phase 1 to approval is less than 10%. For longevity drugs, this probability is even lower due to difficulties with endpoints and long time frames. Problem number 2 is the bottlenecks of clinical phases. Longevity trials are a nightmare for researchers. How to prove a therapy extends life? Wait for participants to age and die? That's decades. Use surrogate endpoints, biological markers that correlate with age and diseases. But correlation is not causation. Improvement in biomarkers does not guarantee life extension or disease prevention. The FDA requires proof of clinical benefit. For cardiovascular drugs, it's a reduction in heart attacks and strokes. For oncology, increased survival. For longevity drugs, what? Increased lifespan? That requires decades-long trials. Delay of age-related diseases? But what combination of diseases counts as success? And how to separate the therapy's effect from natural variability and lifestyle factors? This is a vicious circle. To get approval, long-term data is needed. To gather long-term data, A decade and huge capital are needed. But investors are not ready to wait a decade without interim results. Venture funds have a 10 to 12-year life cycle. They cannot invest in a company that won't give returns for 20 years. And startups collapse before they can prove efficacy. This is the valley of death that kills most longevity companies at early stages. Financial risks are no less acute. Time to market here is critically long. From idea to approved therapy, 15 to 20 years. That's longer than the life cycle of most venture funds. That's longer than the patience of most investors. That's longer than the career horizon of most managers making investment decisions. Classic VC expects an exit in 5 to 7 years, IPO or acquisition. But a longevity company in its 7th year is most likely still in phase 2 clinical trials. It is far from commercialization. Its valuation is speculative, and the probability of an exit is minimal. Regulatory uncertainty only worsens the situation. There is no clarity on how gene therapy against aging will be regulated. CRISPR editing to eliminate disease-causing mutations goes through the standard drug approval process. But CRISPR for enhancement, for increasing the lifespan of healthy people, is terra incognita for regulators. Will it even be allowed? In which jurisdictions? Under what oversight? There is no clarity on how senolytics will be classified. Are they drugs? Then they must pass phase 1, 2, 3. Are they supplements? Then they are almost unregulated but cannot make medical claims. Something in between? A new regulatory class does not yet exist. Companies navigate, trying to find a pathway through existing frameworks. But this creates uncertainty, which the market hates. There is no clarity on whether anything can be marketed as anti-aging at all. In the US, the FTC pursues companies for unsubstantiated anti-aging claims. You cannot claim your product extends life or reverses aging if you don't have ironclad proof, and almost no one has such proof in humans. This drives the industry into the gray zone of wellness and biohacking, without the ability to make explicit medical claims. This regulatory uncertainty is a risk that cannot be hedged. You cannot buy derivatives on the probability of FDA approval. You cannot insure against the regulatory landscape changing radically in 10 years and making your business illegal. Investors are forced to accept this risk as is, and many are not ready. Capital concentration is also a problem. In longevity, as in pharma, a winner-takes-all logic works. The first platform that proves real-life extension in humans will get the entire market, or its overwhelming majority, because it will be the gold standard. All others will become footnotes. This incentivizes aggressive bets on a narrow set of companies that seem like leaders. But it also puts investors in an all-in position on a few bets. If a leader falls and the probability of clinical failure is high, the entire thesis falls. There is no diversification that could protect. A portfolio approach works only if you invest in dozens of companies. But in longevity, there aren't yet dozens of quality investment opportunities. There are 3 to 5 with decent teams, technologies, and data. The rest are speculation. But technological and financial risks are just the tip of the iceberg. Social risks are far more dangerous. Inequality of access to longevity is not an abstract ethical problem. It is a political time bomb. Imagine a world where elites live 150 years, biologically young until 100, working and accumulating capital for decades. And the middle class lives 70 to 80, aging naturally, retiring exhausted. Where access to life extension is determined not by health or need, but solely by capital. Where biological age becomes a visible indicator of social status. This is not a dystopia. It is a logical continuation of the current trajectory. Longevity therapies are expensive. Comprehensive programs cost hundreds of thousands of dollars. Only the top 1 to 5% by income can afford it. And this 1% will live significantly longer and healthier than the other 99. This will create biological class stratification, deeper than any economic inequality we have seen before. Because money can be earned, status can be changed. But if access to life extension is closed, no effort will help you live longer. You are biologically doomed to die earlier than those born into the right families or who earned the right money. Society will not forgive this. Protests against immortal elites are already beginning on the periphery of public discourse. They will only grow when the differences become obvious. When a 50-year-old billionaire looks 30 and a 50-year-old worker looks 60. When the rich will work and dominate until 100, and the poor will be pushed out of the labor market by 60 due to deteriorating health. Politicians will be forced to react. Populist movements will raise slogans about the right to longevity for all. Leftist parties will demand the nationalization of longevity technologies or their free provision through state medicine. Right-wing parties will resist, defending the right of the rich to buy better health. This will become the central political conflict of the mid-21st century. And in this conflict, the longevity industry will come under fire. Regulatory bans, taxes on longevity therapies comparable to luxury taxes or sin taxes, restrictions on the export and import of longevity drugs, compulsory patent licensing, forced price reductions. These are all tools the state can use when the market creates a socially unacceptable outcome. And the political will for this will emerge if inequality reaches a critical point. Biological class stratification is a new form of discrimination, and it will be harsher than property inequality. Because money can be earned, education can be obtained, social status can be changed. But if access to life extension is closed, then no effort will help you cross this boundary. This is biological apartheid, and history shows that such systems do not last long without violent suppression or revolution. There are also unhedgeable risks: ethics, religious and cultural constraints, the politicization of immortality. In many cultures, death is not a biological malfunction, but a spiritual necessity. The cycle of birth and death is integrated into religious doctrines. Attempts to abolish death are perceived as blasphemy, as a violation of divine order. The Catholic Church, Islamic theologians, Buddhist leaders, many have already expressed skepticism or negativity about radical life extension. Religious groups have enormous political influence. In the U.S., evangelical Christians constitute a significant part of the electorate. In the Islamic world, religious leaders shape legislation. If longevity is perceived as contradicting religious beliefs, it creates political resistance that can block the industry in entire regions. The reputation of companies working in longevity is also at risk. One failed clinical trial with serious side effects or participant death, and the entire sector could be stigmatized. One story about how experimental therapy is available only to billionaires and caused unforeseen consequences, and public opinion will turn against the industry. The media loves scandals, and longevity is a perfect target for investigative journalism. Billionaires playing God while millions die from curable diseases. Such a headline will sell any newspaper. Public perception is not a metric reflected in P&L today, but it determines whether the market will exist at all tomorrow. If society decides that the longevity industry is a playground for the rich, ignoring the needs of the rest, then regulatory pressure will become insurmountable. Companies will be forced to close or move to jurisdictions without such restrictions. But this will fragment the market and kill the scale economies needed to recoup R&D. And finally, politicization. Longevity is already becoming a political issue. The left sees in it an exacerbation of inequality and demands state control or free access for all. The right sees a threat to traditional family values and the natural order. Libertarians see an area for deregulation and free market. Populists see a target for demagoguery about elites living at the expense of the people. Each of these groups will try to use longevity for their own purposes. And this means the market will be shaped not by pure economics or technology, but by political struggle. Policy outcomes will be determined not by what is most efficient or fair, but by which political coalition is stronger. And politics is the most unpredictable asset. One election can radically change the regulatory environment. One populist movement can impose bans that destroy billions in investments. And there is no way to hedge against this risk. Let's start with classic life insurance. This industry is built on one simple premise: people die predictably. Actuarial tables, used for hundreds of years, say that average life expectancy in developed countries is about 80 years, plus or minus. Insurance companies calculate premiums based on these tables. They know how many people will die at each age. They know how much in premiums they need to collect to cover payouts to beneficiaries, plus operational expenses, plus profit. It's math. Stable, time-tested, reliable. Now imagine this math breaks. That average life expectancy suddenly starts growing not linearly, as it has for the last 100 years, but exponentially. That people who, according to actuarial tables, should have died at 70 live to 100. That biological age ceases to correlate with chronological age. That 50-year-olds who have undergone longevity therapies have the biological age of 30-year-olds and corresponding mortality risks. Insurance companies suddenly find themselves in a situation where their models don't work. They collected premiums, counting on payouts to beneficiaries at certain times. But payouts are pushed back by decades. On one hand, this is good. Fewer immediate payouts. On the other, it's a disaster for financial planning. Because the investment strategies on which the entire industry rests are built on the predictability of cash flows. An insurance company collects premiums, invests them in bonds and other fixed income instruments, and gets returns sufficient to cover future payouts plus a profit margin. If people live longer, the insurer collects more premiums. Good. But it also must hold reserves for these future payouts longer. And if interest rates are low and inflation is high, the real value of these reserves falls. The net present value of liabilities changes. The entire actuarial model needs revision. And insurance companies that don't adapt quickly will be undercapitalized. Their liabilities will exceed assets. They will go bankrupt. Classic life insurance will either transform radically or disappear. The new model will have to account for biological age, lifestyle factors, access to longevity therapies. Premiums will become dynamic, adjusted annually based on biomarkers. Payouts will be structured differently, not a lump sum after death, but distributed income streams, possibly tied to biological milestones. Insurance will turn into a hybrid product between life insurance and a longevity annuity. Pension systems are the next victim. Modern pensions are built on the assumption that a person works for 40 years and receives payments for 15 to 20. The ratio of contributors to recipients is roughly 3-to-1. The system is balanced. Young workers pay contributions that go to pay retirees. And when these young ones age, the next generation will pay for them. This is a pay-as-you-go model, working under stable demographics. Now imagine a person works for 60 years and receives a pension for 50. The ratio inverts. Retirees live longer than they work. Funds begin to deplete. State budgets cannot withstand it. In countries with aggressive population aging, Japan, Italy, Germany, pension systems are already on the brink. Add radical life extension, and they will collapse completely. The only way out is to radically reconsider the concept of a pension. Either abolish it as a universal right, or make the retirement age not fixed, but tied to biological condition. You are biologically healthy and able to work at 80? The pension is postponed. This sounds cruel, but it's the only way to keep the system solvent. The alternative is a transition to fully funded individual retirement accounts, where everyone saves for their own old age. But this leaves out those who haven't saved enough. The social problem remains. The new career model is not an incremental change. It's a revolution. Currently, a career is built around one trajectory. You choose a specialization at 20, get an education, work in that field for 30 to 40 years, accumulate expertise, reach senior positions, retire. Linear progression with predictable milestones. In a world of 100-year productive lives, this is absurd. A person will change careers 3 to 4 times, not because they want to, but because the labor market will change several times in their lifetime. Technologies, industries, entire economic sectors appear and disappear faster than a person lives one career. Specialization relevant at 30 will be obsolete by 50, obsolete again by 70. Continuous reinvention will become not an option, but a necessity. Education will cease to be front-loaded. It will become continuous. Lifelong learning will turn from a fashionable term into an operational reality. Universities, which now sell degrees to 20-year-olds, will sell retraining to 50-year-olds, 70-year-olds, 90-year-olds. This is a new multi-trillion-dollar market. The market of education for eternal students. Micro-credentials, stackable degrees, modular learning, all this is already forming. But in a world of longevity, this will become mainstream. Revaluation of human capital is something economists haven't fully grasped yet. Currently, companies evaluate an employee on a horizon of 10 to 15 years maximum. Investments in their training, development, retention are amortized over that period. If the employee leaves earlier, the company incurs losses. If they work longer, it's a bonus. But planning is built around average tenure. If an employee will work for a company for 50 years, then the ROI from investments in them increases by orders of magnitude. Training, mentorship, competency development, all this pays off many times over. Companies will start retaining people not with contracts and salaries, but with biological investments. The best retention tool of the future is a longevity benefit. A company that pays for extending your life ties you more strongly than stock options or a pension plan, because this investment amortizes over decades. And the longer you are with the company, the more it has invested in your health. Leaving means losing access to costly therapy. This is lock-in at a biological level, deeper than any financial instrument. Financial implications are even deeper. A person as a long-term asset changes the logic of corporate finance. Companies will start capitalizing investments in human capital on the balance sheet, not as expenses, but as long-term assets. CEO training, their health optimization, their longevity program. All this can be considered as capital expenditure amortized over decades. And this will change corporate accounting. Biology may enter corporate reporting. Companies will start disclosing not only financial health, but also the biological health of key executives. Investors will analyze top management biomarkers as closely as they now analyze earnings reports. The CEO's biological age is a forward-looking indicator. If it grows faster than chronological, it's a risk factor for the company. Leadership transition will have to be planned earlier. Institutional knowledge will be lost. If biological age is slowed or reversed, it's an asset. The company can count on stable leadership over a longer horizon. Some analysts are already starting to include CEO health in their valuation models. Not formally, of course, but in private conversations, in internal memos. If it's known a CEO is seriously ill, it affects stock price. And if it's known they are biologically younger than their passport age thanks to a longevity program, it's a positive signal. Transparency around biological health will become a new norm in corporate governance. Health turns into recurring revenue, not for the individual, but for the economy. A healthy person is a person who produces, consumes, invests, pays taxes. A sick person is a cost for the healthcare system, lost productivity, a social burden. States will begin to understand that investments in the longevity of citizens is not social policy. It is an economic strategy with measurable ROI. Each additional year of healthy life is a GDP contribution. A person who works productively until 80 instead of 60 adds 20 years of economic activity. That's taxes, consumption, innovation. On a macro level, that's trillions of dollars. Countries that realize this first will gain a competitive advantage. They will invest in the longevity of their citizens as in infrastructure, as in education, as in R&D, because the return is measured not only in years of life, but in economic growth. Age will become a manageable variable of the national economy, like inflation, which a central bank controls through interest rates, like unemployment, regulated through fiscal policy. Average biological age of the population will become a key indicator that states will try to optimize. Ministries of biotechnology, which do not yet exist, will emerge in most developed countries. Their task will be to coordinate longevity strategy at the national level. The geography of capital will also shift. Biotech clusters will become new financial centers. Not London with its banking, not New York with its Wall Street. San Diego with its Torrey Pines biotech cluster. Boston with its concentration of biotech companies around MIT and Harvard. Singapore with its Biopolis research hub. Possibly Shenzhen if China can overcome regulatory barriers and attract global talent. This is a new geography of influence and wealth. Cities where longevity research institutes, biotech startups, venture capital, clinical centers are concentrated will become magnets for capital and talent. Real estate in these clusters will rise in price. Infrastructure will be built around the needs of the industry. It's the same dynamic that created Silicon Valley as the center of the tech world. Only here, the central technology is not software, but biology. Exporting longevity platforms will become a strategic task for leading countries. Just as the US now exports tech platforms, Google, Facebook, Amazon, and extracts geopolitical influence from it, tomorrow countries will compete for their longevity platforms to become the global standard. For their protocols, their drugs, their AI aging models to be licensed worldwide. This is the new oil. Only instead of oil, algorithms and life extension therapies. Intellectual property in longevity will become one of the most valuable assets. Patents on senolytics, on cellular reprogramming methods, on AI algorithms for predicting aging. Companies and countries owning these patents will receive licensing revenue for decades, and they will defend these patents aggressively. Patent wars in biotech are already fierce. In longevity, they will become even harsher because the stakes are higher. Some countries are already positioning themselves as testing grounds for longevity research and commercialization. Singapore offers a regulatory sandbox for biotech, fast-track approval processes, generous state funding through the A-STAR research agency. The UAE is building biotech-free zones with tax incentives and minimal bureaucracy. Estonia, with its e-residency and digital health infrastructure, is trying to attract longevity startups with promises of quick access to population-level health data. They understand a simple truth. The first jurisdiction that becomes genuinely friendly to the longevity industry will receive a huge influx of capital, talent, companies. And this will create a flywheel effect. The more longevity companies in a jurisdiction, the stronger the ecosystem, the more collaboration and innovation, the more attractive the location becomes for the next companies. This is a new form of economic competition between countries, and it's just beginning. A new class of infrastructure is emerging. Longevity clinics are not hospitals in the traditional sense. They are hybrids of a medical center, data lab, and exclusive membership club. Clients come not to treat diseases, but to optimize biology. Each visit is a deep examination, biomarker collection, protocol adjustment, testing of new interventions. Aesthetics resemble an Apple store or a luxury spa more than a clinic. Because the target audience is not sick people, but healthy people striving to stay that way as long as possible. These clinics become hubs for clinical trials. Pharmaceutical and biotech companies pay for access to their client base, affluent individuals willing to participate in experimental studies. This is win-win. Clients get access to cutting-edge therapies for free or at a discount. Companies get motivated participants with excellent compliance. The clinic gets fees for organizing and monitoring trials. This turns the clinic into a research platform with multiple revenue streams: membership, data sales, trial contracts, consulting for pharma. The very concept of health is also changing. Previously, health was defined negatively by the absence of disease. You are healthy if you have no diagnosis, if you experience no symptoms. The new paradigm is health as optimization. Health becomes a spectrum, not a binary state. You are not just healthy, you are optimized. Your biomarkers are in the top 10 percentile for your age and sex. Your biological age is 15 years below chronological. Your metabolic profile is finely tuned for maximum efficiency and longevity. Your microbiome diversity is above average. Your mitochondrial function is optimized. This is an athletic approach to life. Just as professional athletes optimize every aspect of their physiology for performance, longevity enthusiasts optimize for lifespan and quality of life. And this requires continuous maintenance. Regular checkups, constant adjustments to diet and supplements, periodic interventions to reverse accumulated damage. Health turns from a static state into a dynamic process requiring active management. And this process requires platforms and services that support it. Hence the huge market for subscription-based health optimization services. Investment strategies are also evolving. Classic biotech investing was built around the drug development pipeline. A company identifies a molecular target, develops a drug, conducts preclinical tests, then phase 1, 2, 3 clinical trials, gets FDA approval, commercializes. An investor enters at an early stage, waits for progression through the pipeline, exits via IPO or acquisition. This is an asset-centric model. Value lies in a specific drug. Longevity investing is fundamentally different. Here, value is not in one drug, but in the platform. In the platform's ability to collect and analyze biological data, train AI models, personalize therapies, retain clients for decades, continuously optimize their protocols based on new data and research. This is platform investing, not drug investing. And the evaluation metrics here are closer to SaaS companies than to pharma. Customer acquisition cost, lifetime value, churn rate, data moat, network effects, scalability. New financial instruments are appearing. Longevity bonds, bonds whose payments are tied to the actual lifespan of a specific population cohort. If the cohort lives longer than the baseline expectation, bondholders get higher returns. If shorter, lower returns. This is a tool for hedging longevity risk. Pension funds and insurance companies that bear the risk of their clients living longer than expected can buy longevity bonds to offset that risk. Investors who believe lifespan will increase significantly can speculate on these bonds. A whole ecosystem is forming around managed longevity. Biohackers who test experimental protocols on themselves and publish results in blogs and on YouTube. The quantified self community that turns tracking biomarkers into a competitive sport with leaderboards and achievements. Longevity influencers who monetize their audience through sponsorships with supplement companies, partnerships with longevity clinics, affiliate links to health tech products. This creates a mass culture around life extension, and this culture shapes demand. People begin to perceive aging not as an inevitability, but as a challenge, as a problem to be solved. They are willing to experiment, spend money, take risks for extra years of healthy life. This cultural shift accelerates the commercialization of longevity technologies, because technology without demand goes nowhere. And here, demand is growing exponentially. An investor in longevity is not an investor in companies. They are an architect of human time. They don't buy biotech startup shares hoping for a quick flip. They form the infrastructure within which people will live longer, healthier, more productively. They don't wait for an exit in 5 to 7 years like a traditional VC. They build a position for 30 to 50 years. Because they understand a fundamental truth. Control over biological platforms is more important than ownership of individual assets. Whoever controls the operating system of life controls everything else. A long horizon here is not a risk. It's a competitive advantage. Most investors cannot afford to wait decades. They have limited partners demanding returns. They have funds with a fixed 10 to 12-year life cycle. They have quarterly reporting pressure. But longevity is a game for those who don't need to answer to anyone in the short run. For sovereign wealth funds thinking in generations. For family offices building wealth for centuries. For those rare institutional investors who can afford to think on the scale of a lifetime, not a fiscal year. And these long-term players understand. The greatest asset is not money today, but time tomorrow. The ability to extend a person's productive lifespan by 20 years is not just a health benefit. It is a fundamental expansion of human capital. It's an extra 2 decades of earnings, investments, knowledge accumulation, network building. On an individual level, this is huge. On a societal level, it's transformative. Thinking shifts along several axes, from companies to organisms. A company is a temporary structure. It can go bankrupt, be acquired, disbanded. Its lifetime is measured in decades at best. An organism is the basic unit of the economy. All production, all consumption, all innovation happens through people. And if you can invest in extending their functionality, then everything else is derivative. Companies come and go. Organisms persist. And whoever invests in organisms invests in a more fundamental layer of economic reality, from returns to life management. A classic investment is measured in annual percentages. ROI, IRR, CAGR, all are metrics of financial return. A longevity investment is measured in years of life, in biological age, in health span. It's a different metric, and it's more fundamental, because money is a means, and time is what people are willing to pay any amount of money for. The richest people in the world, who have achieved everything financially possible, face one problem that cannot be solved with money in the current paradigm: time. They age. They will die. And no billions can help. Until now. Longevity changes this equation. For the first time in history, time becomes purchasable. Not directly, of course, but through technologies that slow or reverse biological aging. And for those with capital, this is the most important investment. More important than stocks, bonds, real estate, art, crypto, because all these assets are meaningless if you don't live long enough to use them. From markets to longevity ecosystems. A market is a place of exchange. Buyers and sellers meet, make a transaction, part ways. An ecosystem is an environment of existence. Longevity creates not a market for products, but an ecosystem within which people live, work, consume, invest, optimize. And whoever controls the ecosystem controls all transactions within it. This is platform power at a biological level. A person is a portfolio, not metaphorically, literally. A set of biological assets. a genome with its variants, an epigenome with its methylation patterns, a microbiome with its diversity, a metabolome with its efficiency, an immune system with its responsiveness, cognitive function with its neuroplasticity. Each of these assets can be measured, optimized, hedged, upgraded. The genome can be edited via CRISPR. The epigenome can be reset via cellular reprogramming. The microbiome can be rebalanced via targeted probiotics and diet. The metabolome can be tuned via personalized nutrition and pharmacology. The immune system can be boosted via vaccines and immunotherapy. Cognition can be enhanced via nootropics and brain training. An investor in longevity manages this portfolio, not their own. That's too narrow and personal. The portfolios of thousands, millions of people. Through platforms that provide tools for optimization. Through data that reveal patterns and guide interventions. Through protocols that translate research into actionable practices. This is portfolio management at scale. And returns are measured not in basis points, but in years of healthy life. Life is a subscription, not in a dystopian sense of subjugation. In the sense of a business model. You don't buy life extension one time. You subscribe to it, monthly, annually, for a lifetime. And each subscription renewal extends not only the service, but life itself. This is a recurring revenue model that literally does not end, because its end is death. And death is the ultimate churn, which the platform fights with all available means. This creates perfect alignment of incentives. The platform is maximally interested in the client being healthy and living long. The longer the client lives, the longer they pay. There is no conflict between profit motive and client well-being. Unlike traditional medicine, where a hospital makes money from illnesses, a longevity platform makes money from health. This is an aligned business model. And aligned business models scale better because there is no ethical friction. Aging is an expense to be optimized. Like any operating expense in a business, it can be measured via biomarkers. It can be reduced via interventions. It can be amortized via long-term programs. It can be restructured via technology. And in the process of this optimization, value is born. Not for one person, for the entire economic system. Because if aging is a cost, then its reduction is the profit margin of all humanity. Imagine the global economy as a giant corporation. Human capital is its main asset, and this asset depreciates with age. Productivity drops, healthcare costs rise, knowledge is lost upon retirement or death. This is a huge drag on economic growth. Now, imagine you can slow or reverse this depreciation. That human capital does not lose value with age, but maintains or even appreciates. This is a fundamental improvement in the efficiency of the global economy. It's more than any technology we have seen. It's the optimization of the basic substrate on which everything else runs. Income is not written off once a quarter, but every year lived. This is a new ROI metric for longevity investment. Not financial return in the traditional sense, biological return. Every year of healthy, productive life is a return on investment in the longevity platform. And this return can be measured, can be compared across different interventions and protocols, can be optimized, can be scaled. A company that invested in a longevity program for a key executive sees the return every year that executive continues to work productively beyond normal retirement age. A sovereign wealth fund that invested in the longevity infrastructure of its country sees the return in the form of increased GDP per capita, reduced healthcare burden, extended productive workforce. An individual investor who invested in their own longevity sees the return in the form of extra years of life they can spend as they wish, working, traveling, learning, enjoying. We stand on the threshold of the greatest economic transformation in human history. Not because radical life extension technology is already here and fully proven, but because capital already believes it will come. And when capital believes, it creates reality. It funds research, it builds infrastructure, it forms markets, it influences regulators, it shapes public opinion. Capital's belief in longevity is a self-fulfilling prophecy, and the prophecy has already begun to be fulfilled. The question is not whether the longevity revolution will happen. The question is, who will be its owners? Who will control the platforms? Who will capture the returns? Who will decide who gets access to life extension and who is left out? This is not a technological question. It is a question of capital. And capital is already giving the answer. Early movers, sovereign funds, family offices, visionary VCs are already positioning. They are building portfolios of longevity companies. They are acquiring data assets. They are securing IP. They are establishing presence in key biotech hubs. Aging is a bug, and bugs in the system are always monetized. We are at the very beginning of this monetization, at a moment when most still don't understand the scale of what's happening, when institutional capital is just starting to enter, when regulatory frameworks are still forming, when public opinion hasn't settled yet. This is a window of opportunity, and it will close. Not in a year, maybe in 10, but it will close. And those who enter now will become architects of the new economy. An economy where time is an asset, where life is a subscription, where aging is an optimizable cost, where a person is a long-term investment, where biology is infrastructure, where data about life is more valuable than data about behavior, where longevity platforms are more important than social networks, where control over human time is the ultimate power. Welcome to the economy of eternity. It has already begun, and it does not ask for permission. It just happens. Driven by capital, technology, the human desire to live longer, and those who understand this now have a chance to become not just wealthy, to become those who determine how humanity will live for the next 100 years. This is not just an investment opportunity. It is a chance to rewrite the rules of the game, where the main stake is life itself.